In this week's video, we'll review the hard data to help us answer the question, are demographic trends an ally or enemy of stock market bulls? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Given it's very easy to find pessimistic headlines in late August, early September 2017, it's always helpful to maintain the proper perspective on opinion and sentiment versus the facts that we have in hand. Do the facts align with gloom and doom, or are they slanted more toward a major boom? If you're watching these videos every week and you say to yourself, I see the bullish charts, but it just doesn't make sense to me based on the state of the world in 2017. Skepticism is part of the historical script. The prevalent mood in the United States in the late 1970s and early 1980s was unquestionably pessimistic. And that dour mood was summed up by Business Week when this cover ran, "The Death of Equities," in August of 1979. And thankfully for long-term investors, the death of equities was greatly exaggerated in the late 1970s, early 1980s. This is where the Business Week cover appeared in August of 1979. And instead of getting a bearish break from this consolidation pattern here, there was a bullish breakout, and the Dow rallied for 18 years from the low in 1982 and posted a gain of over 1,300%. If you find it very, very difficult to look at the bullish charts in the present day, just remember millions of people felt the same way in here, and not many of them would have thought the market was about to rally for 18 years. If we were able to filter out the noise and the gloom and doom in this period here, we would have seen that the stock market was consolidating for a long period of time, and we would have been waiting patiently for either a bullish breakout or bearish breakdown, and we would have seen the bullish breakout. We could see this, measure it, and put it in a model before good things happened. We could make the argument that 1982 represented a very unique demographic period in history, with the baby boomers falling into the 22 to 39-year-old range, meaning they were entering the workforce in 1982, and many of them were getting ready to enter their prime earning years. Economies and markets tend to move based on the law of supply and demand. This is a ton of demand that's coming into the economy and into the financial markets in 1982. We know from past videos that the present day shares many of the characteristics of consolidation followed by a bullish breakout. How about the demographics? Much like 1982 and 2017, millennials are between 13 and 35 years old, meaning they are also getting ready to enter the workforce, have already entered the workforce, and many of them are about to enter their peak earning years, just as these 39-year-olds were in 1982. And in both cases, a long sideways period of consolidation, a bullish breakout, followed by a consolidation box, and followed by a bullish breakout and a multiple year secular bull run. A bullish breakout and to be determined. From a demand perspective, in terms of goods and services driving the economy, demand for goods and services, and demand for financial services, stocks, bonds, mutual funds, how do the baby boomers compare to the size of the present day generation, the millennials? This is an article published by the Pew Research Center on April 25th, 2016. Millennials overtake baby boomers as America's largest generation. A huge wave of demand followed a multiple year period of consolidation. A huge wave of demand is kicking in after a huge and wide and multiple year consolidation box in the stock market. It's important to note we're not forecasting here. We're simply looking at the facts that we have in hand as of August 30th, 2017, in this case, and comparing them to the facts that we had in hand here. We will continue to take it day by day and manage based on the facts in hand. Given there is no shortage of gloom and doom, this type of analysis, a bullish analysis, helps us offset all of the gloom and doom that we're being bombarded with every single day. If we can offset it, it helps us keep an open mind about all outcomes. From the easy to understand gloom and doom to the much, much better than expected outcomes that align with the facts that we presently have in hand. We've covered the late 1970s and early 1980s in the past. If you want to find additional information and how it ties into the present day, you can Google this title here. Given the recent volatility in the markets, the next segment of the video may be surprising to some viewers. Let's start with our familiar quote from Market Wizards. The second item is something that Ed Seykota taught me. When a market makes a historic high, it is telling you something. No matter how many people tell you why the market shouldn't be that high or why nothing has changed, the mere fact that price is at a new high tells you something has changed. Using this quote and these sound principles as a guide, the facts that we have in hand on Friday, September 1st, do they align with gloom and doom, or do they still align with the possibility of much better than expected outcomes over the next several years? The thing that we love about this slide, no opinions whatsoever, facts. Every single one of these ETFs posted a new all-time weekly closing high on Friday, September 1st, 2017. S&P 500, Vanguard, total stock market. This speaks to market breadth. Russell 1000 growth, materials, Vanguard growth, the triple Qs tech, XLK tech, VGT tech, semiconductors, which we've covered in past videos, and healthcare are just a small sample of the many ETFs that are exhibiting strength despite all the gloom and doom. And given many of the ETFs that we have in our portfolios and the ETFs identified by the market model also posted new all-time weekly closing highs on Friday, September 1st, it's providing us with positive feedback for the screens that we added to the front end of the model earlier this year. The screens that we're currently back testing. And everything that we've seen so far says the screens will continue to be helpful, but we'll continue back testing to make sure we're comfortable with that. Since August of 2017 is now in the books, it's a good time to look at a lot of the consolidation patterns and see if the bullish breakouts are still in place. And to reinforce the concept that the longer a market goes sideways, the bigger the move that you can expect to get when you either get a bullish breakout or bearish breakdown. The longer a market goes sideways, the bigger the move that you can expect to get. Tying all of this back into the present day, consolidation, a big gain, consolidation, and our expression is the longer a market goes sideways. Sideways here for 5 years, big gains followed. Sideways here for 20 years with a bullish breakout. We showed this on June 1st of this year. The NASDAQ was at 62.29. The breakout is still in play on September 1st. Intraday, we were trading at 64.34, comfortably above the 20-year consolidation box. Similar situation NYSE Composite stayed inside of this orange box for 19 years. We showed the breakout on June 1st. We're still above the box at 11,929 on September 1st. We can find charts all over the globe, including the London Financial Times Index, inside the box for 21 years, and a bullish breakout with price remaining above the box on September 1st, 2017. The longer we stay above the box, the more meaningful it becomes. And we know that even if the future includes better than expected outcomes, and our goal is to navigate from a point A to a point B that may be several years out in the future, it's never going to be easy because there's going to be a ton of 100% normal and to be expected volatility between a point A and a point B. And it requires a tremendous amount of discipline to navigate from point A to point B and avoid these common human missteps. Point A, point B, a ton of volatility in between. If the markets continue to exhibit strong trends, all things being equal, we would prefer to trade less rather than trading more frequently. And it's much, much easier for us to remain patient if we understand that the big money in the markets is typically made between a multiple year point A and point B. It's very, very difficult to capture a 965% gain by frequently trading your account between point A and point B. It can be done, but it's done by a very, very, very small percentage of traders. And we also need to reinforce this seems ludicrous at this point. But in this context, it is not ludicrous. This consolidation box here is much, much shorter than this consolidation box here, telling us it's possible, within the realm of possibility, that the gain from this point A to this point B sometime in the future would be larger than 965%. Whether or not that happens, it remains to be seen, and we'll take it day by day. The facts that we have in hand on September 1st, just as the facts that we had in hand on June 1st, 2017, still align with the possibility that that could take place. Our theory after this breakout here was that good things could happen for a long period of time. We reviewed this chart on July 13th. It still looked good. How does it look today? As of September 1st, it still looks healthy and aligns with bullish probabilities from a long-term perspective. This is the look that we want to avoid in the NASDAQ. This is the look with the same weekly and, for illustrative purposes only, moving averages on Friday, September 1st, 2017. This is the rollover look we want to avoid in the Dow. And this is the Dow on Friday, September 1st, 2017. We said long-term momentum was turning up in a positive manner back in December of 2016. Has anything changed? Since August is in the books now, this is the look of monthly MACD that we want to avoid. This is the look that we want to embrace. This is the look on Friday, September 1st, 2017. The charts speak for themselves. They can't predict the future. They help us with probabilities, and right now the probabilities, based on the facts in hand, remain favorable. Can't emphasize enough, the purpose of this week's video is not to forecast anything. We're simply looking at the facts that we have in hand and assessing the probability of good things happening relative to the probability of bad things happening. Continue to take it day by day, and we'll maintain that maximum flexibility, allowing us to see changes in the data if and when they occur. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.